Okay, hey everyone, welcome to today's webinar brought to you by Vantage. Just want to check how's everyone going. I hope you're all doing well and ready to dive into what I think will be a really important market discussion. Do let me know in chat box how you guys are going, how's trading like for you guys, where are you from actually, and what time is it where you're at? Okay, cool. So I hope everyone is doing well, regardless, and ready to dive into today's topic. So this session is all about two massive trends that are shaping the financial markets right now. So gold's record-breaking run and the global shift that many are calling the death of the dollar. Okay, although I do see trend reversals, but it did deep a lot. Okay, so these aren't just flashy headlines. These are real movements in the market and that can have a direct impact on your trading and your investment. So now I want this webinar to be a little bit more interactive. So if you have questions, insights, or even if you disagree with something I say, just write in a chat box. It's okay. I want you guys to communicate with me. I want you guys to talk to me. You don't have to be shy. Okay, the more we engage, the more valuable this lesson becomes for everyone. So I'll be checking in with you throughout and we'll also leave time at the end for a proper Q&A if you guys do have any questions. But most of the time, you guys always ask me like throughout the webinar. So I'll just answer as I go. Okay, so in the next 1 hour, we're gonna be breaking down exactly what's driving goals record run, why this move is so significant, and how you can approach it from a trading perspective. Then we're going to dig into the death of the dollar, what's really going on behind that phrase and how global power shifts are changing the currency landscape, and most importantly, how to trade in a world where the US dollar might no longer be king. Okay, this isn't just a theory. I'll be sharing live examples, recent price action, and the macroeconomics backdrop so that by the end of this session, you'll have a clear roadmap for identifying opportunities and managing risk in these changing markets. So with that said, let's get started with today's topic and why it's happening, what's fueling it, and what it means for us traders. Oh, by the way, guys, this is gonna be a really like heavy topic. So yeah, don't be shy. Just ask me questions, okay? I try to keep it as basic and like as understandable as possible. I totally get it if it doesn't make a lot of sense to some of you, especially if you are a beginner, but it's okay. An overview is better than nothing. Okay, so all right, so before we get into the charts and market talk, I just need to go over the usual but important disclaimer. So as you guys know, everything we're discussing today in this webinar is for educational purposes only. Nothing in this webinar should be taken as financial advice, trading recommendations, or a solicitation to buy or sell any financial instruments, okay? Trading in the financial markets involves risks, and it's important to understand that you can lose more than your initial investment. Only trade with money you can afford to lose, and always make sure you have a proper risk management plan in place. So past performance does not indicate future results. The market can and will change. So any examples I show are just examples and it should just be taken as educational purposes and nothing more than that. Okay, so again, reminder, please do not take this as any form of investment advice. I'm going to stay here for 1 minute so you guys can slowly read through the disclaimer. It's really important that you guys don't just jump into this head on. Like, it's trading is really, really dangerous. I mean, if you don't know what you're doing. So please be cautious. Yeah, I'm just going to stay here for 1 minute so you guys can read the disclaimer. Just making sure the chat is working. Yeah. Seems like it's working. Okay, cool. Now that's out of the way. Let me do a quick introduction of myself so you know who's guiding you through today's session. So my name is Cassandra and I'm an investment analyst at Everest Fortune Group, a research house that has been a finalist for best research in Forex and equity for multiple years running. Our team specializes in delivering high quality data driven insights to some of the biggest brokers, institutes, and traders worldwide. So I am a prop trader. I mean, other than that, which mean that which means that I don't just talk about the markets, I'm in them every single day. Yeah, so trading with real capital and managing risk, just like the traders I work with. So I've spent years studying price action, macroeconomics, trends, and technical strategies across Forex, commodities, and indices. Okay, so over that time, I've developed a sharp understanding of what moves the market and how to position ahead of those moves. My job, both as an analyst and as a trader, is a bridge that gaps between complex market information and practical actionable strategies that anyone can understand and use. So I believe that the best trading education doesn't just give you the what, it gives you the why and the how so you can make informed decisions for yourself. Okay, so I want you to know that this is a space where you can ask questions freely, whether you're brand new to trading or you've been doing it for years. No question is too basic or too advanced. If something isn't clear, just speak up and drop it in the chat. I'm here to help you walk away from this webinar more informed and more confident than when you came in. Okay, so with that, let's begin. And we'll begin with one of the biggest market stories right now, gold's record run, basically. Okay, so our agenda for today is we'll start with the basics with what exactly are safe havens. Assets, okay, we'll define the term, look at the assets typically considered safe havens, and talk about why they're so important to both investors and traders, especially in times of uncertainty. So second, we'll tackle the big question on everyone's mind. Why has gold surged with bonds and the dollar have collapsed? This is where we connect the dots between macroeconomics factors, market sentiments, and central bank behavior. So third, we'll explore alternate safe havens to consider. While gold is the classic example, it's not the only game in town. Okay, we'll look at other assets that can serve as a store of value or hedge during market stress. And finally, we'll bring it all back to trading. How do we find opportunities in safe havens during volatile times? I'll share strategies, entry and exit considerations, and a few tips on managing risk so you can navigate this market with more confidence. By the end of this session, I hope you'll understand the bigger picture of what's going on, but I also hope that you have a clearer idea of where to look for trades in the middle of all this volatility. Okay, so what are safe havens? Let's start with the foundation. What exactly is a safe haven? Asset. Okay, in simple terms, safe haven in an asset people run to is an asset people run to when things get scary, when markets wobble, headlines turn ugly, or uncertainty spikes. So capital looks for a place where that's more likely to hold its value or even rise while riskier assets fall. Think of it like an umbrella in the rain. Okay, but there's a first nuance. Safe haven does not mean that it is risk-free. No asset is perfectly safe in every scenario or every time frame. Safe haven behavior is conditional. It depends on the type of stock shock hitting the markets. A growth scare is different from an inflation shock, and both are different from a geopolitical crisis. So, an asset can behave like safe haven in one situation and lose that status in another. Okay, so rather than memorizing a fixed list, we want to understand the qualities that make something a safe haven. So, stability under stress, okay, holds value when stocks or cyclical assets fall. The other one is deep liquidity, easy to buy or sell quickly in large size, low counterparty or credit risk, not relying on fragile balance sheet and broad acceptance, trusted globally as collateral or a store of value, monetary quality, so there's scarcity, durability, and independence from any single government. Okay, so let's talk about what kind of currencies or what examples. So in currency, the classic safe havens are the US dollar, um, the Japanese yen, the Swiss franc, backed by large stable economies and deep financial markets. So in bonds, historically, top tier government debt like US treasuries and German bonds have been seen as safe havens because they're liquid, they are backed by strong repayment capacity in commodities. Gold is the standout. No one's ability, limited supply, and trusted globally for thousands of years. Okay, so equally important is what doesn't automatically qualify. So defensive stocks will fall in broad market sell-off. High grade corporate bonds carry company risk. Real estate is too illiquid in a hurry, and crypto, despite being called the digital gold, often behaves like a risk asset, rising in good times and falling in panic. So there were risk on and risk off comes in. This is where risk on and risk off comes in. We'll talk about that later on in the webinar. Okay, risk on is when investors feel confident and equity rise. Cyclical currencies do well, yields may climb, and safe havens can lag. Risk off is when fear takes control, equity drop, volatility spikes, and flows rush into safe havens like the Japanese yen, the Swiss franc, or often gold. And actually, other things are coming up as safe havens, and we'll talk about that shortly. Okay, so far, does anyone have any questions? If you do, let me know in the chat box. I will love to help you guys with any of your questions. By the way, we're streaming on multiple platforms. So we're also streaming on Vantage's app and we're also streaming on Zoom. So those who are on Zoom, can you just say hi so that I know that it's working? Okay. I'm gonna stay here for a minute. So, I mean, if you guys have got any questions, just throw in the chat box and I'll answer it shortly. Okay, cool. I do see questions coming in, so let me just read one of it. If gold is already record high, isn't it too late to buy now? Okay, that is a really good question, actually. So price alone doesn't tell us whether an asset is overvalued. Okay, it tells us where it's trading relative to its history. So what really matters is why it's at record highs, if the underlying drivers like central bank buying, inflation, concerns, or dollar weakness are in place, the trend can continue to go higher. So just because it's highest right now, it doesn't mean that it is at its max level. Okay, it can still go higher. That said, I wouldn't chase every new high blindly. I'll look for pullbacks and strong support levels or periods of consolidation before considering an entry. So you're not buying at an emotional extreme. You can use technical analysis as well to like kind of get in and maybe combine it with like fundamental analysis to see where price is going. Okay. So why is the US dollar weakening if it's supposed to be a safe haven? That is another question. I'm gonna get into this in the next few slides. Okay, but yeah, that is a really good question, and we're gonna cover that in the next few slides. How do I know if market is in risk on and risk off mode? Okay, I'm gonna touch on that towards the end of the slide as well. Thanks, guys. You guys are asking quite good questions. Can crypto like Bitcoin really be considered a safe haven? Okay, so like I mentioned earlier on, crypto has this characteristic. I mean, it's known to be safe haven or like digital gold, right? That's what it's known to be. But it kind of behaves like a risky asset. It sometimes rise during good times and then during bad times it falls in panic. So is it really a digital gold? I mean, I don't know. So the thing about anything in this world is the majority consensus, right? So if everyone is agreeing that it is, it will be. I do at some point, at some degree, think that it is a digital coin, a digital gold, but I just don't like how it behaves that in that way. Okay, so I'll call it I mean, me personally, I'll call it a conditional safe haven asset at best. It can work in some situations, but it's far more volatile than traditional havens like gold or the yen. Okay, so I've got one more question. What's your number one tip for trading safe havens during volatile markets? So my number one tip is to trade with confirmation and not prediction. So the difference between trading and gambling is that trading comes with calculated risk. So you kind of use like whatever data you can collect, technical analysis, fundamental analysis, news, or whatever it is. Okay, and then you make your decision. But the thing about like gambling, for example, you cannot like there's no data to use because it's pure luck, right? Like you can't be like, oh, okay, so the last three times black won. So now I'm gonna bet for black rather than red. Okay, for example. Okay, so don't assume the market will move into a safe haven flow. Wait for the price action and macro signals to confirm it. And once you're in a trade, keep your risk small and stops in place because safe haven flows can reverse quickly on new headlines in volatile markets. Survival is as important as profit. Okay. Okay, cool. If you guys have more questions, I'm gonna answer them in a while because these slides are a bit long today. So I do want to try to finish it before the 1 hour is up because you guys know that I get cut off during that 1 hour. So, I mean, if the 1 hour is done, I do get cut off. Okay, so let's move on with what are safe havens. So you can spot safe haven flows by looking for certain market signals, equity falling, volatility climbing, government bond yields dropping, JPY and CHF strengthening across the board, and gold breaking out while risk assets fade. In crisis, you'll often hear flight to quality, moving into higher quality assets and flight to liquidity. Okay, moving into assets you can sell instantly if needed. In big panics, both happen at once, but safe havens aren't perfect. Policy changes, inflation spikes, or domestic instability can dent their performances. Hey, bond can lose their defensive edge in inflation shocks. Gold can chop sideways for a long period. It's literally chopping sideways right now. Even reliable havens like the Japanese yen or the Swiss franc can stumble if local conditions shift. So nothing is guaranteed. It's just safer than the rest. So as a professional mindset is not this is safe forever, but rather this asset is likely to behave defensively in a specific type of shock. And here's how I'll size and risk manage it. Think of safe havens as tools in your trading kit, not guaranteed. Use them to hedge risk, protect capital, and position for volatility when uncertainty arises. Okay, so if I have a question here, if bonds are collapsing, does that mean they're no longer safe havens? I'm gonna touch on that in a while. Okay, it's actually my next topic. Thank you for asking. Okay, thank you for asking. So the answer to that is actually not necessarily. Okay, bonds can still act as safe haven, but their performance depends on the type of risk the market is reacting to. Okay, so anyways, let's start with this topic so that I can go in depth and answer your question. Okay, so let's start with gold side of the story. So why it's been surging? Recently, we've seen gold not just test all highs, but break through them and hold above. This is not a short-term spike. It's a sustained rally and has caught global attention. There are several factors at play. First, gold is a classic safe haven. When uncertainty rises, people move into assets that are no one's liability. You can't be printed at will and have held value for thousands of years. So, I mean, that's definitely gold, right? It's been around for a long time. So right now, the market is navigating multiple uncertainties, geopolitical tensions, slowing global growth, and questions about central bank policies. Second, inflation concerns haven't gone away, even though central banks have been raising interest rates to combat inflation. The cost of living in many countries remain elevated. When inflation eats away at the value of fiat currency, gold's appeal as a store of value increases. So third, we're seeing record central bank buying. Countries like China, Russia, Turkey, and several emerging markets have been adding gold to their reserves as part of diversification strategies, reducing their reliance on the US dollar and building a more stable reserve base. This official sector demand is important because it's consistent and often immune to short-term speculative swings. Okay. How do central bank gold purchases affect the market? Okay, um, that is a very good question. So, okay, I'm just gonna finish this in a while. So in short, gold search is being fueled by fear, inflation protection, and strategy buying from some of the most influential players in the market. Okay, so central bank buying significant amounts of gold because it's persistent and long term. Unlike speculative traders, central bank buy for strategic reasons. Okay, so they don't buy and then they sell, they buy and then they hold to diversify reserves and reduce currency risk, right? So when they're buying at record level, it creates a strong underlying demand that can help support and push prices higher, especially if other buyers join in. So how it affects the market, it's just gonna push it higher, and then that's just gonna be a lot more volatility for us traders. I've got another question here. If the US dollar is weakening, then should I sell all my US dollar pairs across the board? Okay. Not automatically, because so the dollar might be weak against some currency and strong against others. So depending on interest rate differentials and economic conditions, for example, USD might be falling against gold and the Swiss franc, but still rising against weaker emerging markets currency. Always check relative strength rather than assuming all USD trades will go the same way. So another thing is you don't initially have to essentially have to get rid of all your US dollars or whatever it is. Because the thing is, price is constantly moving in a zigzag. Anyways, like price is going up and then there's always going to be a pullback. So you can always just play the pullback. You can always just, if you want to buy or you want to short, whatever it is, you can always play whatever direction it is because price is always going in two direction, whether it's going on a long term or whether it's going on a short term. Okay, cool. So I'm gonna move on. Okay, we're gonna talk about while gold has been surging, bonds, particularly long-term government bonds, have been under pressure. To understand why, remember this, bond prices moves inversely to yield. So when yield rises, okay, when yield rises, bond prices fall. So if bond prices fall, yield rises. Okay, so it's just inverse. Okay, yields have been rising because central banks have tightened monetary policy aggressively to fight inflation. This means new bonds are issued with higher interest payments, making older bonds with lower yields less attractive. So their prices drop. Inflation also plays a direct role here. When inflation is high, the real return on bond, that's the yield after adjusting for inflation, can be negative. If inflation is at 4%, but your bond yields only 3%, you're effectively losing purchasing power. That makes bonds less appealing as a safe haven. So there's also the issue of government debt levels. Many countries are carrying historically high debt to GDP ratios. Investors worry about the sustainability of this debt, especially when interest rates are high and the cost of servicing debt rises. That can cause a shift away from long duration government bonds and into other assets like gold, okay, that aren't tied to government credit worthiness. So instead of being the usual go-to safe haven, bonds have been losing their defensive edge in their environment. Okay, but it does not mean that it's totally like, it's just totally bad. Okay, it doesn't mean that. It just means that it has been losing a little bit of its edge. Okay, then okay, very good question, guys. So why is the yen considered safe haven even though Japan has high debt? Okay, Japan's debt is mostly held domestically, okay, which reduces default risk. Plus, Japan is a net creditor nation, meaning it owns more foreign assets than it owes abroad. In global turmoil, Japanese investors often bring money home, creating strong demand for the yen. It's less about debt levels and more about the country's external balance and capital flows. Okay? Okay, cool. If you guys any more questions as of now, if not, I'm gonna move on to our next topic. Yeah. Thank you for joining. Thanks for teaching us. Okay, thank you for joining. I'm glad you guys are here. Okay, I'm gonna move on. So why has gold surged but bonds and the dollar collapsing? So as you guys know, the US dollar has been under a lot of pressure and for a few key reasons. First, the interest rate advantage is shrinking. Okay, for much of the last 2 years, the Federal Reserve was ahead of most other central banks in raising rates, which made holding US dollars more attractive. But now, as the Fed approaches the end of its hiking cycle, the other central banks are still tightening and that advantage is fading. So secondly, we're seeing de-dollarization trends picking up momentum. So countries are signing trade deals in currencies other than the US dollars. So oil, for example, is increasingly being priced in yuan or local currencies in certain bilateral agreements. This reduces structural demand for the US dollars in global trade. Okay, thirdly, reserve managers, central banks, and foreign wealth managers, wealth funds are diversifying away from the dollar and into currencies and gold. So like other currencies, I mean. This is partly geopolitical, a way to reduce vulnerability to US sanctions, and partly financial, as they seek a more balanced reserved mix. Okay, so basically people are just spreading their eggs in different markets. When I say people, I mean countries. Okay, so people are using the US dollars less, and yeah, the demand is lower now. That's why the US dollar is dropping, because there's no demand, therefore the currency is gonna be dropping. Okay, so the combined effect is that the times of stress, safe haven flows that might normally have gone straight into the dollar are now being split, with a significant share heading towards gold. So certain currencies like the yen or the Swiss franc are and even commodities. Okay, this shift is one of the reasons why we've seen the unusual combinations of gold up, bonds down, and the dollar weakening, a pattern that tells us we're in different kinds of market regime and we're been used to. Okay, so alternate safe havens to consider. While gold, bonds, and the US dollars are the classic safe havens, everyone talks about, they're not the only options. Okay, there are other options. And in certain market environments, other assets can play the role just as effectively, sometimes even better. So the first thing to remember is different crisis favors different safe havens. So in geopolitical shock, gold and the Swiss franc might shine, okay? In a banking crisis, short-term government bills or certain currencies might be preferred. In an inflation shock, commodities often outperform. So let's start with the currencies first. Okay, so the go-to is usually the Japanese yen. It's one of the most reliable safe havens in the global risk off environment. Japan has a huge net foreign asset position, meaning it owns more overseas assets than it owns. Okay, in times of stress, Japanese investors often repatriate capital, causing the yen to strengthen. So the next one will be the Swiss franc. Okay, it's backed by Switzerland's political neutrality, strong banking system, and reputation for stability. A lesser talked about example, which I really like because I am based in Singapore, okay, is actually the Singapore dollar. Okay, while it's not as globally traded as the yen or the Swiss franc, it's backed by one of the world's stronger fiscal position, low debt, and prudent monetary policies. In regional market stress, especially in Asia, the SGD, Singapore dollars, can be a relative safe harbor. So on the commodity side, silver and platinum share some gold's safe haven properties, but also have industrial uses, meaning they can benefit from both defensive flows and certain cyclical recoveries. Okay, I've got a question. So is silver a better safe haven than gold right now? Okay, good question, because you're asking this right now. Right now, silver can benefit from safe haven flows, okay, but it also has a large industrial demand component, which makes it more sensitive to the global economy. If growth slows sharply, that industrial demand can weigh on prices. Gold is generally the purer safe haven play, while silver can offer higher percentage gains in risk-off environments, but also higher volatility. So basically, gold is safer, okay? Gold is safer. It's just that it will not move as much as silver in certain market conditions, okay? Why is yen considered a safe haven even though Japan has high debt? Okay, again, Japan's debt is mostly held domestically, okay, which reduces default risk. So it's within the debt is within Japan itself. So Japan is a net creditor nation, meaning that it owns more foreign assets than it owes abroad. Okay, so yeah, it owns more overseas than within than what they owe. So for example, Japan owns $20 of US asset, but only owes them $10, for example. Okay. So it's less about debt levels and more about the country's external balance and capital flows. Okay, one more question. How can I trade safe havens without like overexposing my account? Okay, so this answer doesn't even have to be about today's topic. Okay, this question, it's a good question, but it doesn't even, it's just a question, a good question in general. So you can use smaller position sizes, diversify across a couple of safe havens assets instead of just one, and always have a stop loss in place. I'm going to talk about that a little bit later on, actually. So you can always scale in, just start small and add only if the trade moves in your favor rather than going in all at once because you do not want to be risking your entire account anyways. Could the Swiss franc lose its safe haven status? Okay, it's very unlikely in the near term, but nothing is permanent. Nothing is ever permanent on this planet, okay? If Switzerland's financial system faced a major crisis or if its economy became much more volatile, for example, investors' confidence could shift. That's why we always watch markets' behavior and then we kind of have to adapt to the markets rather than assuming any haven will work forever. Okay, cool. Alternate safe havens to consider. Another category of alternate havens come from short end of the curve, short-term government bills like 3-month US Treasury, Singapore T-bills, okay, or government or German Scotch. Okay, I don't know if I'm pronouncing correctly, but these carry minimal interest rate risk compared to long-term bonds and are highly liquid, making them attractive when investors just want to park cash safely for a while. So high liquidity money market funds are similar. High quality money market funds are similar, sorry. They invest in short-term investment grade debt, offering liquidity and a small yield without the volatility of long duration bonds. They won't make you rich, but in market turmoil, capital preservation is the point. Okay, so some investors are, yeah, I mean, if it's market turmoil, right, you do not want to be thinking of growing your money. You can, it's risky, okay? You just want to preserve. If during market turmoil, as long as you're not losing money, you're basically winning, okay? So some investors also use defensive equity sectors like utilities or consumer staples as partial safe havens. They're not immune to market drops, but they tend to fall less than the broker market because demand for electricity, food, and basic goods is, it's always going to be constant. Okay, so for traders and investors who prefer packaged products, they are defensive ETFs and low volatility funds designed to reduce drawdowns during market stress. This can be useful tools for diversification, though it's important to remember they still carry equity market exposure. Okay, there are also emerging niche safe haven candidates, though these tend to be more situational and require careful risk assessment. In some commodity-driven shocks, certain commodity currencies like Canadian dollars, Norwegian krone can behave defensively if the underlying commodity they are tied to is in demand. So for example, oil prices spikes can support the Norwegian krone. Okay, I don't know if I'm pronouncing it right. Then there's also crypto, particularly Bitcoin, which can market participants call digital coin. or digital gold. In certain scenarios, such as capital flights from unstable currencies, crypto can act as a store of value, but in a broad global risk-off event, it has historically behaved more like a risk asset. So I personally, okay, maybe some people will not agree with me. Okay, I personally would classify it as a conditional safe haven asset at best. Okay, so real assets like farmland, infrastructure, or physical real estate can protect value over the long term, especially against inflation. However, they lack liquidity. You can't exit them quickly in a panic, and they're better thought of as strategic hedges, not tactical safe havens. So the key takeaway here is diversification. Okay, please diversify. I am a prop trader, okay, but so little of my money, my entire net worth is in the markets, okay? A lot of my net worth is from property, and yeah, a lot of it is in property actually, and businesses, property. And there's a small percentage in like investment and like trading and whatnot. Okay, because diversification is key. So because you need to remember that no single safe haven works in all situations. Okay, so by combining several, for examples, holding gold, some short-term bonds, and a stable currency, you can build a more resilient defense against different types of market shocks. Okay, I've got a question here. Do safe havens work during every type of crisis? More specifically, gold. Okay, no. Okay, the effectiveness of a safe haven depends on the type of crisis. In inflation shocks, gold might perform better than bonds. In banking crisis, short-term government bills might be preferred. And geopolitical events, currencies like the Swiss franc or the Japanese yen might be strongest inflow. Also, also match the haven to the scenario. Okay, doesn't like gold, you cannot just go for gold in every scenario. Okay, it's not gonna work that way. Okay. Trading opportunities for safe havens amidst these volatile times. Okay, let's look at the last subtopic and then we should be done, and then we can just cover some of the questions if you guys have any. If not, then we'll still have a few more minutes. I'll probably be able to pull out TradingView if you guys want. If yeah, we'll see. Let's just play by ear. I've got another question. If the death of the dollar is happening, will the US economy collapse? I do not want that to happen, to be honest. Although I am not very like a bulk of my investment is in property, right? But whatever I invested in the markets are very heavy on the US. So I personally do not want that to happen. So to answer you, not necessarily. The dollar losing some of its global dominance doesn't mean that the US economy will vanish completely. Okay, it might weaken, but it's not going to vanish completely. It simply means that trade and reverse reserves might become more diversified. The US will still be major economic powerhouse, I hope. Okay, but the currency might share the stage with others like the euro, although I doubt it's going to be the euro, yuan, or gold in global transactions. So I think more likely it's going to be like crypto, the Chinese yuan, and mm, gold. Okay, so trading safe haven assets isn't about guessing, it's about recognizing when the market is in a risk-off environment and acting accordingly. The first step is to understand the overall tone of the market. Is it in the risk on where optimism drives stocks and cyclical currencies higher, or is it in the risk off where fear sends money rushing into havens? You can spot risk off by looking for a combination of signals. So equity indices falling sharply, volatility spiking, JPY and CHF strengthening, bond yields dropping, and gold breaking out. When several of these happening together, you know safe haven flows are active. So I'll give you an example of when this happened. When Trump announced that he was gonna do like that tariffs thing, I think the market was definitely in a risk on mode. Okay, it was like crazy. There was so much volatility. Gold was just shooting up, was making new highs and then new highs and new highs. Okay, so like you just know because it's so obvious. It's so obvious, like there's so much fear in the market. Okay, I think now, like if I have to say today, I would say there's a little bit more calmness compared to when the announcement was just happened. Hey, you can kind of see gold moving sideways now. So people are like, it's just consolidating right now. So it's almost as if the fear has stopped or is in a pause at this current point of time. Okay. So yeah, it's very obvious. So once you confirm the environment, focus on assets that have been showing consistent safe haven behavior. So a really good example would be gold. If gold has rallied every time equities drop, that's a pattern worth trading. If JPY strengthens broadly whenever headlines turn negative, that's your cue. Okay, so the key here is confirmation. Avoid jumping into just because you expect fear to rise. Wait for the market to show you it's actually moving into defensive posture before committing capital. This reduces the risk of getting caught in a false move. Okay, so these are for people who are also using like a lot of like fundamental analysis and a lot of news to like get their analysis. Okay, I personally use a lot of technical analysis where I totally don't look at the news at all because technical analysis somehow just still moves according to what the news wants it to move. Okay, but I think it is a good practice to also combine fundamentals if you can. If the central banks are buying gold, should I just copy them? Okay, very good question. Central banks buy for strategic long-term reasons. If you are going to buy for long-term reasons, then definitely go for it. Okay, they just don't care. They don't care about short-term price swings. So you can align with that trend. But as a trader, if you are going into like catch the moves and some flows, I don't recommend it. You just need to manage your timing, your entry levels, and your risk. So if they are buying, it is a good signal to look for a buy entry or look for buying opportunity, but it doesn't mean that you have to. Okay. Okay, so when trading safe havens, there are a few strategies that work particularly well. First, trend following during strong safe haven flows. If gold is in a confirmed uptrend and macro conditions support it, look for pullbacks to buy rather than trying to pick tops. Okay. Same goes for currencies like JPY and CHF. In a strong risk-off phase, it often pays to go with the flow. Yeah, just go with the flow. Just go with the waves. Don't try to fight it. Okay. Second, mean aversion. After overextended moves, safe havens can rally hard on panic headlines, but once the initial fear subsides, there's often a partial retracement. If the move looks stretched on technicals, and sentiment has reached extremes, there may be opportunity to fade it. Okay, so third, pair trading to isolate safe haven strength. For example, if JPY is strong and AUD is weak, AUD JPY could be a high probability short during risk off. Okay, this way you're trading relative strength rather than betting on one asset alone. And finally, using multiple time frames. Okay, like what I included there, to refine your entries and exits and basically just combining technical analysis, okay, to make your analysis, your trade good. Okay, so the daily chart might show a big trend, but the 1 hour and 15 minutes chart can help you time entries around key technical levels. Okay, so you do need to master like technical analysis to kind of like refine your entries. Okay, next will be the last part of our entire webinar, and then we can do a little Q&A session if you guys still have questions. Okay. Safe haven trading can be profitable, but volatility cuts both ways. So risk management is critical. Always size positions conservatively when markets are turbulent. Just because a trade looks safe doesn't mean that it can't move against you quickly. Smaller sizing allows you to stay in the game even if the market gets choppy. Place stop loss orders beyond obvious technical levels to avoid getting caught in quick stop hunts. In highly emotional markets, prices can overshoot before resuming the original direction. Be aware of headline risks. Safe haven flows can reverse sharply on unexpected news, like a surprise central bank announcement or a sudden easing of geopolitical tensions. Have a plan for how you respond to major developments. Finally, please diversify your approach. Don't put all your risk into safe haven. For example, you might hold some gold exposure, a defensive currency pair trade, and a position in short-term government bills. This way, you're not dependent on a single asset's behavior. The bottom line is this, okay? Volatile times create opportunities, but only for those who stay disciplined, okay? If you're gonna throw all your eggs in one basket, I can assure you you're gonna end up quite burned in the end, okay? I mean, it's not 100% obviously, right? But it's a high chance of getting burned. Okay, it's a high chance because of one wrong move and you are fully exposed. So if you manage your risk and trade with a clear plan, safe havens can be one of the most reliable profit sources in uncertain markets. Okay. That being said, gold is just moving sideways right now, so this you might want to wait. Okay, so that's our webinar for today. Thank you very much for joining our webinar today. Thank you for all your questions. Thank you for being interactive. And thank you for joining. Okay, so do link up with us. This is our handles. These are our handles. You can go on Facebook, Instagram, Twitter. I mean now it's called X, LinkedIn, and Telegram. If you guys want to like stay updated and just see what our team has to offer. Okay, if you guys have any more questions, I have 4 more minutes. I can quickly answer some of them and then can end today's webinar. Okay, I see one on the app. How does political instability affect safe haven flow? So how does political instability affect safe haven flows? Okay, it affects it a lot because it's related, right? It's correlated. So political instability creates uncertainty, right? Which often pushes investors towards assets perceived as stable, like what we were talking about the entire webinar, which is like gold, Japanese yen, um, I mean, you can consider silver and Swiss franc and whatnot. Okay, so yeah. Why would anyone buy bonds if inflation is high? Okay, that is a very good question, actually. So some investors like pension funds or insurance companies have mandates actually to, I mean, if I'm not mistaken, yeah, they do have mandates that requires them to hold certain amount of bonds regardless of conditions. So others may buy short-term bonds where inflation impact is smaller and they may be betting inflation will fall and bond prices will recover. Does a strong gold price always mean that economy is in trouble? Very good question. It does mean, I mean, when price is going, it means that people are running to safe haven most of the time, but I would say not always, okay? Gold is still rising during healthy economies if demand from jewelry, technology, or central banks is strong. So, I mean, the sustained rallies driven by safe haven flows usually indicate that there's an underlying economic or market concerns, but I mean, not all the time, but I would say majority of the time. Okay. Does the yen always strengthen when the US stock markets fall? Okay, so like I said, the Japanese investors, they hold a lot of like foreign assets, right? So when markets turn risk off, they often sell those assets and bring them back home to Japan. Okay, you know what I mean? So let's say like they hold a lot of like US assets right now, and then they see, okay, US is in trouble. So they start selling off all their US assets and they bring all that money back to Japan. So it creates a demand for the yen. So I mean in this sense, yes, um the yen will always go up when US stock market falls or when there is like some kind of trouble somewhere, because they'll just get rid of whatever they have overseas and then bring it home. So I think Japanese are incredible for that. Okay, yeah, that's all I have for today. Thank you for joining today's webinar. Take care, everyone. I hope you guys have a good trading journey. I hope you guys are profitable. I hope you guys are using risk management well so that you can be profitable and your trading psychology is in the correct place, okay? Because if you cannot, oh, there's an insect here. Sorry, there was an insect flying in my face. If you guys cannot work on your trading psychology, I can promise you you're not going to be a very profitable investor or a trader. Okay, so please do work on that. Go and read some books that are available. There are so many books that are available on trading psychology. Work on your psychology first before you work on anything else. Okay, that's all I have for you guys today. Take care. I'll see you guys next week. Bye.